Why aren't Americans buying more when a greater number are being employed? That is a puzzle for many economists and the Fed, and one I want to sort out with our next guest, former Fed Chairman Alan Greenspan. Chairman Greenspan, thank you so much for joining me this morning. We're hoping you can solve some of this mystery as to why we're adding jobs and it looks great, but we're not spending. What's going on here?
Well, it's unfortunately very simple, but not a good story. It's turning out that we're using more and more people at the margin to produce less and less. Productivity, which is output per man hour as we conventionally measure it, is running at a very low rate of increase, and that's the critical variable in the economy over both the short term and the long term. So what we're confronted with right now is a very serious problem caused by the fact that capital investment has been falling far short of the requirements necessary to keep the capital stock growing and therefore productivity. It's not working.
So how do we reverse that? What exactly is behind that, Chairman?
Well, I've on many occasions indicated that the best way to understand this is to track it backwards. There's a very tight relationship between the stock of non-residential private stock and output per hour. They move together parallel in all the time for very good reasons. But that capital stock requires capital investment, and capital investment in turn is being crowded out by a very substantial increase in government expenditures, basically in entitlements, because both parties, both the Republicans and the Democrats, don't want to talk about it, largely because it is considered the third rail of American politics. You touch it and you lose.
Well, so that makes perfect sense. So it might come down to cutting some costs, right, to cost controls, Chairman. Top of your list, I know you've mentioned entitlement spending. You know, you've got Medicare, Social Security. The number one thing that you think we need to cut our cost on is what?
Well, the basic issue is the entitlements. And the reason it's a problem is that people put money in of their own funds and their employers' funds plus interest, and that's what they perceive that they get back, and therefore they are entitled to it because it's their money.
Right.
The only problem is that's not what we're doing. We're not creating enough funding for the Social Security trust funds, and the same thing goes for Medicare Part A. And we're not funding this, and so long as we're not funding this, we are dollar for dollar crowding out capital investment.
Dr. Greenspan, you know, some look at these numbers, though. I mean, not just jobs, but the lack of productivity, as you just pointed out, also the spending declines that we are seeing, but also the strength of the dollar as perhaps delaying the Fed policy on raising interest rates. I know you don't speculate, you don't want to interfere on Janet Yellen's job, but all of those factors combined, do they foreshadow perhaps a longer wait on moving on monetary policy?
Well, you're merely repeating what is probably going on in the internal discussions of the Federal Open Market Committee, and I won't comment on that.
Okay, understood. The higher dollar, though, Dr. Greenspan, is that going to have, or do you believe it's going to keep a lid on inflation?
What do you mean? It's productivity or what's going to keep a lid?
The higher U.S. dollar. Okay, so we just talked about how the higher U.S. dollar should be reducing import costs for many companies. It's not so far, but if it does, is that going to help alleviate some of the inflationary pressures and possibly the need, again, not to forecast raising interest rates or not, but the need to tighten?
Yeah, no, there's no question. A stronger dollar tends to suppress the general domestic price level. But the problem here is we're not quite certain where the problem on the exchange rate comes from, whether it's a strong U.S. economy, which is a questionable issue, or a weak rest of the world, which is a little bit more credible. And remember, where the exchange rates in a global economy are a zero-sum game. If the dollar goes up, something else goes down. And what we're seeing is a significant weakening, obviously, in the euro. We're seeing it in the ruble. We're seeing it in the yuan. So, I mean, it's a very, very complex problem of international trade and international capital flows. And it's not altogether clear that the U.S. can readily make major changes in the dollar's exchange rate, because it's such a critical currency that the types of actions that we would have to take probably are outside the realm of where we would think it's good policy.
Chairman, I know that oil is something that you have been watching very closely. You say it's extremely important for us to be watching what happens to oil. You believe we still haven't hit rock bottom here, right?
That's correct, Betty. If you look at the data, as you just pointed out, our major domestic facility for storage is in Cushing, Oklahoma, which is the delivery point for West Texas Intermediate crude contracts. We're probably at the point now where at the current rate of fill, we're going to run out of room in Cushing by next month. And then the question is, where does the crude go? Because everyone's forecast as to what was going to happen when the prices collapsed was a sharp curtailment in shale oil production. That has not happened. The weekly figures which are produced by the Energy Information Agency through March the 6th show a continued rise in domestic crude production, and it has got no place to go because we can't legally export the way we would most products. We can do a little exporting to Canada, but essentially we're bottling up a huge amount of crude oil in the United States, so that the West Texas intermediate price is running $10 a barrel under Brent crude, which is the global price. And that basically means that we are creating great abnormalities in the system. And unless and until we find a way to get out of this dilemma, prices will continue to ease, because there's no place for that oil to go except into the markets, and spot crudes are especially vulnerable because the so-called contango is a very high level, and that implies that there's a very, very significant set of pressures on the spot price.
But Dr. Greenspan, what about this theory, though? I mean, when it seems inevitable we're going to see this huge oversupply and oil prices come down even more, isn't that eventually going to hit U.S. oil production? It might be a very sharp crash in the number of rigs that get closed down, but eventually the markets will adjust?
Well, remember, the rigs that have been closing down have not been affecting the capacity to produce crude yet, and the reason is that most of them are the ones which are not multiple well related. You're getting the inefficient rigs shutting down, but the capacity to basically build a oil expansion remains there. And frankly, I had expected it to turn down or ease a number of weeks ago, and these numbers keep rising. Now, it is perfectly credible that because the cost of crude, especially, I should say, for shale crude, which is more expensive than standard old-fashioned crude, those numbers are high, or, $55, $65 a barrel. There is some Eagle Ford shale which is going under $50 a barrel. But there's not much room under there before cash flow turns negative. At that point, they shut down, and it could be quite abrupt, as you point out.
Right, that's right. It could be very abrupt. Then Chairman Greenspan, if nothing is done here, short of, let's say, a lift of our export ban on crude, what could we expect from OPEC?
Well, I think that OPEC is no longer the price leader. I wrote a long editorial op-ed piece last week or so in which I pointed out that essentially what's happening is that because of the advent of shale, which is a very much more flexible type of facility to expand and contract crude, that the marginal global price-making mechanism has moved to the United States away from OPEC. And I think that that's going to continue unless and until prices fall below the costs of crude production from shale, which is very significantly above where, for example, the Saudi crudes. There are some Saudi crudes which can be lifted at less than $1 a barrel in the Ghawar fields, in the huge Ghawar field in Saudi Arabia. We're lucky if we can get $40.
That's incredible. Yeah, no, that's a great point. It's incredible, and it sort of brings to light just how complicated the situation is. Dr. Greenspan, thank you so much for joining us this morning, the former Federal Reserve Chairman, Alan Greenspan.